Hello, everyone. Good morning, good afternoon, good evening from wherever you are joining us. Very happy to see many of you joining and coming up more and more. So, my name is Rebecca Thyssen. I work at Cannes International, and I'm really happy to welcome you today to the first ever edition of the Cannes Finance School. And today we are launching the first cycle, which is about unpacking private finance for climate action, and so what it means for our work on climate justice. And I do want also to really appreciate the fact that you're taking time in this very fast evolving context, in a world where everything is evolving so fast, where things are very fragmented and divided. I think it's really important actually to take time to think and dive deeper, to ask yourself important questions about our work. So really appreciating you all being here today. So just one quick word about the finance school. So the Cannes Finance School offers a curriculum style series of workshops designed to build a collective expertise on critical finance topics. So it would run a series of learning cycles, each one of them focusing on key area identified by the network and our partners. The goal is to equip the climate justice community with knowledge, confidence, and strategic understanding that are really needed to advance the finance and economic justice agenda, which is a central pillar of Cannes 5-year strategy. And you hear a bit more about it later on. So each cycle will consist in 4 to 5 workshops with recordings and materials shared afterward. And I'm also really happy to tell you that we'll also be sharing at the end of this call and every other day of the week a toolkit where not only you'll have recording and slides, but also materials to engage and dive deeper into the content. A quick caveat, the finance school is not a space for internal positioning debates. Discussion on network position and advocacy alignment will take place in existing CAN structure based on network needs and appetites. So now just briefly introducing this session. So as you all know, private finance is increasingly promoted as the primary solution to close the finance gap. So government, development banks, international institutions, many actors are placing a growing emphasis on these private sector first approaches and all the financial mechanisms designed to attract private finance investment into climate action. But of course, that raises a lot of questions. Who benefits? Who carries the risks? What happens when profit becomes the condition for climate action? And what kind of public system, safeguard, democratic accountability are needed to ensure that finance supports justice rather than extraction? So this is exactly what we're gonna delve into and what the Cannes Finance School will try to unpack in those 4 coming days. So as you can see on the slide, so we will first look today at the big picture, the politics shaping private finance and what it means for climate justice work. Tomorrow, we will go through the question of how does this relate to the international financial architecture, its institution, and what it means in terms of private finance promotion. And then session 3 and 4, so on Wednesday and Friday, we look specific at diving into key instruments that are being used and promoted for us to really build a collective and technical understanding of what it means for climate justice. So, final words, who can join? This session is really open to any CAN members and partners who are willing to know more and to learn about critical finance and economic questions. Also note that the session will be recorded and published on CAN YouTube channel. Finally, a question that you may ask yourself already, how to participate. So the first and the easiest way is to use the Q&A box down below your screen, where you can share your question, but also your reflection and your own experiences. Some of them will be directly asked to our speakers today, but we also make sure that we monitor and look at everything you send our way to build also future work around this topic. But also, watch out for the survey we will be sharing later on this week. Not only, of course, to have a feedback from you of how you liked or not the school, but also to help us shaping the next steps. whether you all like or not you would like to build a strategic space to discuss what we had heard from the speakers and think what it means concretely, but also to have your inputs on what the next cycle could look like. So many things coming your way. Watch out for this space. And now I'm very happy to hand over to our executive director, Tasneem Essaf, executive director of Can International, to just give us an opening remarks and tell us a bit why we're here today and what it means for collective work. Tasneem, floor is yours. Thanks.
Thank you very much, Rebecca, and greetings to everybody. It really is a big honor to welcome you to the first session of our finance school as CAN. Of course, this will be a starting process of initiating the idea of schools on particular topics, and there is nothing more important, of course, than the issue of finance and climate finance particularly. Why have we decided to do a finance school with a particular focus on private finance? As you've heard from Rebecca, there is unfortunately a growing trend, especially with global North governments, to start shifting the conversation about climate finance towards a conversation about private sector finance, about investments and how we unlock investments, about how we de-risk these investments, about how we look at the cost of capital, etc., etc. And so what should have been a conversation about the obligations by the global North to provide grants-based public funding is turning into one that shifts their responsibility to the private sector, to multilateral development banks and other international financial institutions. And it is deeply concerning for us because, of course, when we as a network together with all of our allies decided to take up the climate finance fight at the COP in Baku, our focus was about getting global North countries to pay up, and the campaign was called Pay Up Your Climate Debt. Our focus was on public finance, and that the global North owes the global South a climate debt to the tune, and that was conservative as well, to the tune of 5 trillions. And so what we were talking about is not billions or millions, but trillions. Now, of course, we didn't get anything near that outcome, but what we did put on the agenda very strongly, and especially with global South governments, is we shouldn't be accepting the 100 millions or 100 billions, etc., which is now, of course, a 300 billion commitment made by the global North. Again, not just public finance and the kind of private sector finance mixed up in that. It cannot be acceptable because climate finance is not about charity. Climate finance is not about aid. Climate finance is, in fact, fundamentally about delivering climate justice and delivering that climate justice to the global South, who are least responsible for the climate crisis, and in addition, who have to now bear the brunt of additional climate impacts due to the continued actions by global North countries in not reducing their emissions. Global North countries have 2 obligations in terms of the, amongst others, in terms of the convention. The one is to lead in reducing their emissions, which they've not done, and definitely not in terms of what is required. And secondly, to provide climate finance, which they have also not done at the scale needed, and now, of course, moving towards shifting the responsibility towards the private sector. This finance school is going to be important for us to understand, as Rebecca says, the implications of all of that for climate justice, but also for all of us at national levels when our governments, especially in the global South, are being faced with this shifting of responsibility but all the increasing responsibilities that we have to take on through our domestic budgets. So, for example, we already know that the majority of global south countries are reeling with debt, which shuts down the fiscal space to just even deliver our development needs, let alone the needs that's growing much more in terms of addressing the impacts of climate. So we know, for example, that impacts of climate is becoming more frequent, more devastating, and costing governments money just to address those disasters. And yet they are in debt and will continue to be in debt. I want to make two last points about the context as well. So here we have a context, global south reeling in debt, picking up all the costs of climate action, especially for disasters and loss and damage. There's not enough money for loss and damage. At the same time, global north countries have been cutting their development, their ODA, and very dramatically so in the past 2 years, in fact. And so the total amount for development aid, also an obligation by the global north, is around 388 or 389 US dollars in the past 2 years. For context, in the past 2 years alone, global north countries and the G7 specifically has exponentially escalated their funding for military, for wars, for destruction, to the tune of, in fact, 3.9 trillion US dollars. Now we have to put that into perspective. The global north is taking money, public funds, and shifting it into militarization and wars and conflicts and genocide. At the same time, they're cutting their ODA, over 50% already cut in the last 2 years. And with Trump, of course, it's been much more in terms of USAID cuts, etc. This is the context in which we are sitting. So shifting the responsibility to the private sector is very convenient for global north countries and shirking their responsibility. And we are not asking global north countries to take away money, their taxpayers' money, away from their taxpayers and taking care of the needs. What we are talking about is reviewing policy choices and priorities that's being made by the global north right now. You can stop funding destruction in the global north. You can stop funding wars. You can stop subsidizing the fossil fuel industry. You can make, increase your revenue by taxing windfall profits made by these industries, fossil fuels, military, tech companies right now, and take care of the needs of your citizens, and at the same time also fulfill the obligations that you have towards the global south. So hopefully you will find the finance schools for this week, the sessions, very useful for you to do your work on the ground at national levels with your government, but also within the global spaces that we all organize around. Thank you very much, and good luck to the finance school, the first of its kind. Thank you very much.
Thanks so much, Tasneem, and thanks also really for highlighting this kind of paradoxical situation and narrative we've been hearing over and over again about the fact that there is not enough public finance, and also really flagging how many solutions we have actually on the table. So now I will pass it over to Saher Rahehar from CSC India, as well as Hamdi Benslama from ActionAid International, to lead us to the second part of the discussion and present our speakers. So over to you.
Thanks, Rebecca. Hi, everyone. My name is Seher. I work with the Center for Science and Environment in New Delhi as a program officer in the Climate Change and Green Economy program. It's a pleasure to be here and to introduce our very esteemed speakers. So, Daniela Gabor is Associate Professor in Economics at the University of West England, Bristol, and Professor of Economics, SOAS University, London. She studies central banks, shadow money, just transitions, and green industrial policies through a critical microfinance lens. Daniela has served as an expert advisor for the European Parliament, the G20 under the Brazil presidency, the United Nations Fourth Financing for Development Agenda, civil society organizations, as well as central banks. She's currently running 2 funded projects, namely Rethinking Developmentalism for Climate and Social Justice with Ndongo Samba Sila Ideas Network Africa, as well as Redesigning Finance for Climate Justice, a Big Green State Approach. So, welcome, Daniela. And our second speaker today is Jody Ann Wang, who is a PhD candidate in international development and a member of St. Hugh's College. A central theme in her research is how finance reproduces structures of power, inequity, and ecological catastrophe in the global south. Grounded in the experience of disaster risk financing in Jamaica, her doctoral project interrogates how finance emerged as such a prominent and promised solution to the climate crisis and what effects will come of it. So we are very excited to have you both on board. Thank you for joining us. And I will now just, without any further ado, hand over the floor to Daniela to open our first session for today. Welcome.
Thank you. Can you hear me? Yes. Okay. Well, hi, everybody. Good morning, good afternoon, wherever you are. It's a great pleasure to be here. I often say that it's important to think about finance and macro financial politics in order to understand ongoing development debates. And I want to make 3 broad points today. I didn't bring a PowerPoint because it's a short intervention, but hopefully these 3 points will provoke some sort of conversation, reflection, and I'm very happy to suggest further readings in order to go deeper into this point. So the first point that I want to make is that I call it a development paradigm of mobilizing private finance. I call it the Wall Street consensus. It's alive and well. It's been launched in 2015 formally at the 3 different United Nations conferences, and since then, even if the Trump administration is no longer formally on board, it's still very important. So the Wall Street consensus is alive. This is the first point. The second one is the Trump administration is doing, or it's accelerating and pursuing the same strategy, only that not through US aid anymore, but through the Development Finance Corporation. And we have to be careful and monitor what that means for Global South countries. And the third point is, going beyond the critique and thinking about what can we do strategically in response to this ever-growing push for mobilizing private capital. And I will talk about what civil society organizations can do in global spaces, but also what civil society organizations in the global south can do. And here I will be a little bit provocative because I know the state is not always the kind of first choice solution for how do we deal with climate distress and all sorts of other development challenges. But I think we have to think very seriously about reoccupying the state before big finance does it. So let me start with the first one. Since 2015, since the launch of the SDGs, the Paris Agreement, and the Addis Ababa Financing for Development Conference, we have this new version of the Washington Consensus. Remember, the Washington Consensus told us that the best strategy for development is to liberalize, privatize, and use the central bank in order to provide price stability. Since 2015, this Washington Consensus that got increasingly discredited has been replaced by what I call the Wall Street Consensus, which is broadly a development paradigm that says because of shrinking fiscal space, and we have a lot of sort of political economy analysis of why fiscal space is shrinking, but because of shrinking fiscal space, what development aid and governments in the global south should do is to enter de-risking partnerships with private finance. And de-risking is a very important word here. It's not, I haven't invented it, although I have written a lot about it. I haven't invented it. It's something that private finance uses. It's something that development aid uses it to basically signal or a partnership between the state, between concessional aid providers and private investors with the idea that we can increase private capital mobilization as long as we make development projects investable. So sometimes I also describe the Wall Street consensus paradigm as a paradigm of investable development. What does this mean? It means basically, if BlackRock, the largest financial institution in the world, if BlackRock wants to invest in a private energy, let's say a wind farm in Kenya, it doesn't go there because risk-adjusted returns, so how much money it makes after all the risks are taken into account. These risk-adjusted returns are too high. So the idea is if the government or concessional aid providers come in and take some of the risks away from this project, then this investment will happen. And if we scale this enough, we will get the trillions, and this is where the billions to trillions agenda or motto coined by the World Bank, this is where it comes in. The idea is if we can organize de-risking partnerships in a way that provides the risk-adjusted returns that private investors want, then you get a lot more financing for development, then you get the SDG goals, et cetera, et cetera. So this paradigm of investable development has been there for the last decade. The World Bank even sort of tried to mainstream it institutionally through various incentives in the Maximizing Finance for Development project that it launched in 2017. And what we learned last year in Seville, and if I have time, I'll talk a bit about my experience of working with the United Nations Expert Commission for FFD4. What we learned in Seville is that although the trillions the trillions discourse has disappeared. You don't see it in global spaces anymore to the same extent. The logic of investable development is still very powerful. As in, the diagnosis of Seville was we haven't managed to mobilize the trillions in private investment, but it's not because this is the wrong development paradigm. It's because we didn't organize de-risking well enough. We don't organize the relationship between the state and private capital well enough. And what we need to do is to organize it better. So, for example, you have country platforms and you have the JTEBs, the Just Energy Transition Partnerships, or all institutional efforts to try to scale up de-risking with the idea that we can accelerate private capital mobilization if we find the right carrots, right? It's a carrots-only strategy that says if you throw subsidies towards private finance, then maybe you'll get higher private capital mobilization. Now, why hasn't it managed? And I think the diagnostic here is very important, thinking also about solutions. So the research that I've been doing for the past decade suggests to me that the reason why we haven't, or why development aid hasn't managed to mobilize trillions, it's because not only does it privatize public ownership of social goods and energy infrastructure, so it's the same old agenda of privatization that we had in the Washington Consensus, but it's a much more contested politically development paradigm. What do I mean by this? It's much more contested. If we look at the experience of African countries that I know quite well, even Vietnam or Indonesia, every time a government, for example, is trying to mobilize private investment in energy, think about independent power producers, right? This is the model of investable energy that has been promoted by European Development Finance Organization, by USAID before Trump administration closed it down. It requires both concessional de-risking from DFIs, and it also requires local de-risking from the government or from the state that says, I'm going to provide you with a 20-year purchasing power agreement that takes the risk of demand away from the private investors, because it guarantees that the state will buy a certain amount of energy at a predefined price. Now, this is basically, in many ways, it's quite ironic for students of capitalism, because it suspends the most basic intuition of capitalism that, private companies survive if they are competitive in the marketplace. Here, the competition disappears out of the window because investors get guaranteed returns. And if we look at the experience of countries like Kenya, Nigeria, I would say South Africa, Senegal, this logic of de-risking, when it's implemented, because it has very significant power asymmetries between private investors and the government when these de-risking agreements are negotiated, this logic of de-risking is creating both fiscal time bombs and political time bombs. What do I mean by fiscal time bombs? It generates very significant fiscal commitments towards or fiscal transfers towards private investors that often become political time bombs because the public starts to realize how expensive it is, for example, to de-risk a US private equity fund that holds the Nigeria's Azura Edo plant. The same with the Lake Turkana wind project in Kenya. It's very expensive. Basically, there are gigantic fiscal transfers that are involved in these de-risking arrangements, and it's very difficult for governments, even if the World Bank sets up many public-private partnership initiatives, offices, whatever it is, it's quite difficult to work out or to defend politically and publicly de-risking arrangements that generate such significant fiscal transfers for private investors. So this is a very significant obstacle, I think, in the way of mobilizing private capital. I suppose this is a good news that we will never have trillions in private capital mobilized simply because of the amount of fiscal resources, plus the regulation, plus privatization that this involves. And it's not just about energy. You could look at healthcare, for example. You could look at education. You could look at water. You could look at roads. You could look at transport. Everywhere, it's more or less the same logic. So when you hear that it's the fault of local governments, that they don't know how to do the de-risking enough, this is it's the same kind of Washington consensus explanation of blaming local dysfunctional politics. But the problem is it's a structural feature. So this is why it's not proceeding enough. But despite this critique that the Wall Street consensus or the private capital mobilization agenda is not moving fast enough, the consensus in Seville, and last week I was also at the OECD conference on the future of development cooperation, the consensus there as well was we have to find ways to mobilize capital faster. The World Bank is creating has already established a new guarantee platform. Many DFIs are doing the same, trying to sort of better integrate the various ways in which concessional aid and grants are moving away from being given directly to governments towards being channeled into de-risking subsidies for the private sector. So that's the first point. The Wall Street consensus is still alive. Yes.
You have about 2 minutes more to.
Very good. That's enough. The second one, we tend to think that the Trump administration, once it dismantled US aid, has kind of washed its hands of international development and said, okay, the disaster follows, and this is not my problem anymore. But if you look at what's replaced the US aid, which is the Development Finance Corporation, it's basically doing de-risking under a national security agenda, with the same US private equity firms that we had before, and with added the layers of blackmail and political bullying for countries in the global south like Zambia or Congo, in order to get access to critical minerals or all sorts of other what they think are strategic priorities of the US. The same, I would argue, and we can talk about it if you want, for the strategy to use AI, artificial intelligence, to use the AI as a way to reestablish the hegemonic dominance of the US in the global south. And I'm going to finish with this. So the Trump administration is still doing it. It's not so obvious in international development spaces because they are not there. Although the World Bank, I think, continues to represent the risking push. The third thing that I wanted to say, so what do we do about this? If the diagnostic is correct, that private capital mobilization is still the political priority of European, global North countries, we can do two things. One, on the short run, is to push for the biggest win in the Seville Compromiso, in the United Nations Financing for Development Conference last year. The biggest win was that the Seville Compromiso acknowledges on paper that private capital mobilization is not aligned with development outcomes. They say you have to align them. This is a strategic win because from there we can say, okay, show me how you align these. Show me in any kind of private capital mobilization strategy that you have as a DFI, as a global North government. Show me what kind of indicators you have developed in order to mobilize, to ensure alignment with development outcomes. So that's something that we should be thinking about and pursuing more systematically. And I'm going to finish with this. The bigger question is, can we just engage in defensive strategies that are trying to slow down this bigger political push towards de-risking? And I think not. And I think there we have to acknowledge that in an age of climate crisis, only the state can organize on its balance sheet a much faster decarbonization than what we had at the moment. And then we have to think, and I would like civil society organizations to think, what kind of accountability mechanisms can we develop for a big green state to make sure that it delivers on promises rather than falling into the traps that we know state-led development projects can have.
Fantastic. Thank you. Wow. Okay. There was a lot of concepts that you brought up that might be a little new for some of us here. So we'll maybe tackle them in the Q&A. But thank you. Thank you so much. I'd like to invite Jody to please come in now with her session.
Thank you so much, Sahir. And I want to thank Can, first and foremost, for hosting the space to talk about a topic as important as the power and politics of private finance. And I think it's really great and very difficult as well to follow what Tasneem has said and what Danielle has said. But I want to begin by saying that I think I recognize how sensitive it has become to talk about private finance in the climate space. It carries a lot of charge to it, I think, especially after the new collective Quanta Gold fight. Those of us who have been in this place for a while now know that it's far more than just a simple economic debate, because private finance has become so much more towards a moral imagination of climate governance, and it's been promising a lot of things to all of us, right? About the scale that it could achieve, about the sophistication in its technical design. It's talked a lot about the urgency and the efficiency in private finance disbursement, and also a certain type of pragmatism that comes up when we are thinking about the geopolitical world and what kind of the dominant narrative tell us that we need to accept. So I'm not interested per se in debating or framing the question around whether private finance is good or evil. And I think sometimes we have gears kind of slightly sway towards that direction. It would be too reductive of an exercise, in my opinion, to do so. So the question I'm interested in unpacking here is, why has it become so difficult to imagine and be part of the climate finance discourse without private finance? How has it become so prominent? What has made it so, and under what conditions? And I think Daniela spoke to a lot of that already, and through what kind of narrative of legitimacy, right? And with it, what happened to public finance? So I want to recall 4 claims that I think a lot of us have heard throughout the climate negotiations, throughout kind of reading a lot of the policy documents, and I wanted to then unpack them 2 by 2. So the first one is that the claim is that finance must come from all sources, public and private. And the second one is that it must be mobilized from a wide variety of actors. This bilateral, multilateral, alternative, public, private. The third is that there's simply not enough public money to solving climate change. And the last one is that the role of public policy, and also relatedly climate policy, is to create the enabling conditions, the attractive investment environments, so that we can, quote unquote, unlock private climate finance. So let's take a look at the first 2 claims together, right? And going back to 2024, when we were splitting hairs about the NCQG, the final text language called on a variety of sources, public and private, bilateral and multilateral, including alternative sources. Sounds quite ambitious. We're widening the pool of where money comes from. We're asking everyone pull in, pull together, and everyone play a role, right? The emphasis, the phrases of all sources sound neutral, but I think what we need to acknowledge is that what sits underneath that seemingly neutral claim was a shifting political terrain of obligation and responsibility. And so if we trace the genealogy of climate politics, looking at it from that angle, I think to complement what Danielle has said, kind of looking at the Washington Consensus, there was a time when responsibility was named more directly, right? 1972 Stockholm Conference, UN Declaration on the Human Environment, recognized that developing countries would need substantial financial and technical support to meet their needs. And that sat right alongside the recognition of sovereign right to development and the principle that states should not cause environmental harm beyond their borders. But from the late 1980s and into the 90s, we did see a shift away from this responsibility pinpointing. From the Brundtland Report, Rio Declaration, Agenda 21, UNFCCC, all of that there on forward, it opened a new era of thinking about climate politics that took place under the age of neoliberal expansion. So environmental politics became increasingly shaped by the language of markets, of ecological modernization, and very approaches that are quite managerial in terms of thinking about the financial system. And researchers have traced this quite extensively. So, for example, in Agenda 21, I think it was quite a heavy emphasis on market mechanisms and environmentally sound technologies. And, Kyoto's clean development mechanism was talking about investing in emission reduction or removal projects in developing countries. So by the time we reached the post-Copenhagen period, especially after 2009, the language shifted even more towards voluntary contribution, towards thinking about transparency and voluntary pledge making, and the idea that all actors have a role to play, which on paper I think sounds quite inclusive to some people, but what it's also doing is it's flattening the very responsibility and obligation that we've been talking about. And this was significant in three ways, right? It firstly neutralized rich countries and historically polluting countries' responsibilities in creating climate chaos by making it everyone's duty to resolve. And then it also secondly blurred the lines of absolute accountability to governments and polluters and replaced it with pledges and techniques that are more involved around transparency, right? And thirdly, it called to scale up, increase the quantum of climate finance pledges with private contributions, with private leverage, with market creation as its fundamental kind of pillar. So private finance came into all of this space not because it had money, not because it had capital, right? We're not looking at it from a plug and play dynamic, but because the grammar of climate politics had changed in a way that it made space for the role of private finance. And we're seeing that with the rise of country platforms where all sources, again, everyone plays a role, become this coordination structure where you can have donors and development banks and private investors and governments and various domestic actors all brought together to perform the task of making the transition an investable thing. And that leads us to unpack the next two claims, which we hear all the time, right? Public budgets are constrained. The scale of the climate crisis is way too large to be met with public finance alone. But, if we hold on a second and think about, well, not enough compared to what? And is it because the money doesn't exist or because the money went elsewhere? And this is what Tasneem said in the beginning, right? When we're seeing climate finance not existing, we're looking at public resources continue to be mobilized at extraordinary scale towards global military spending, towards fossil fuel subsidies, and towards fortifying the border regimes that are kind of expanding, and towards rescuing and bailing out big finance when their own speculative behavior has threatened the collapse of the system. So we're made to believe that scarcity is somehow an economic condition, and we're meeting that with austerity measures. But I think it's really important to remember that the scarcity that we see is a political choice, and some people might see it as a crisis of prioritization, but I think it's going further than that, right? At a structural level, it's a political choice that's being made on the path of least resistance so as to not disturb a global system that's organized around fossil dependence, around extraction, around private accumulation. And when we hear this word kind of fossil capitalism, a lot of people think about it as energy, but I think it's describing the macroeconomic order that we're in, right? It's embedded in how we structure the economy and how, we're expecting that everyday growth must be met through extraction. And, I saw the question in the chat earlier as well, and I think about fossil fuel subsidy. And I think this is why Brett Christopher's work here is quite important, because he's reminding us that the energy transition is not driven by price alone, right? When renewables are becoming cheaper and more price competitive, capital is not automatically moving away from fossil fuels because it does not follow price, but because it follows expected profitability about how we consume about the future, right? It also follows risks and returns and everything else that gives indications around expected profitability. So when we surrender ourselves to the claims that there's not enough public finance and that private finance must plug the gap, we're also accepting the discipline and the logic and the rationale of private finance. So then we're seeing that climate policy itself is then reorganized around that discipline of private finance as well, and around what can be made profitable, what can be de-risked, and what can be translated into a revenue stream. Sorry, I see you coming onto the screen. I might close the time.
Yeah, maybe just one more minute, and then you can conclude. Yeah.
Right. I think maybe because we're running out of time, and that there are other speakers later on in the session who will go into some of the technical details of the different instrument designs, but it's very much kind of what we're seeing with the rise of green bonds and other color shaded bonds, and the different markets and country level platforms that Danielle alluded to, and I think Professor Celine Tan will talk about tomorrow as well. I think what I hope is for everyone to come out of this session kind of raising more critical questions about when we hear these common narratives that are being deployed that are very much politically charged, to kind of start asking the critical questions of, like, when we're thinking about risk being reduced, and what other kind of risk is being left unaddressed, or when we're thinking about enabling policy environments, then what kind of political possibilities are we foreclosing through those narratives? Because ultimately, I think if the political imagination of the just transition becomes reliant on whether justice can be made more profitable, then we're on a completely wrong path here. And I'll stop there.
That was poetic. Thank you for stopping on that perfectly articulate note. Great. So I think now we come to the much awaited Q&A session part of the session. So I'll just hand over to my colleague Hamdi to kind of lead us on that one. Thank you. Thank you, Jody.
Yeah, super. Thank you, Sarah, and thank you to the speakers, and thanks also to the listeners who are asking questions in the Q&A box. Please feel free to add any questions you might have. Yeah, as you said, like we have a lot to unpack. I think we had a lot of concept de-risking, bankability, profitability. So maybe I will just start with these basic questions to make sure everyone is on the same sort of level of understanding. Daniela Gabo, you were telling us about basically the de-risking model and the Wall Street consensus that emerged in 2015. Can you tell us a little bit more precisely and more in detail, maybe basically what de-risking is, maybe at project level? You mentioned, for instance, JPs or country platforms. If you can basically maybe give like more precise example there, and also what it entails in terms of politically. You talked also about fiscal and political bonds, but basically how does JPs sort of shift the costs maybe of climate action. I will group that also maybe for the other speaker with the second question on that we're touching upon just now. On profitability, basically, what does it mean, like profitability becoming the sort of scale that or the criteria that steer capital towards climate projects? And I also see a question. Sorry, I also share a couple of questions, group them in one round. I see a question in the Q&A about private carbon finance. So there could be also a good example maybe to understand, like, basically the politics essentially behind this modality of finance. So maybe you can start, Daniela, and then Jody, you can complement. Thanks very much.
Thank you. Okay, let me try to go slower. So if we think about a government in the global south that is trying to accelerate its renewable sector, right? As in to try to accelerate the shift from fossil fuels towards renewable energy. It can do it more or less in two ways. One is to say, I'm gonna try to create a publicly owned renewable sector in which I import, I don't know, all the capital goods from China or other countries that have that allow or give cheap capital or the inputs, or I can do it because I don't have the fiscal resources. And here Jody provided you with a very interesting critique and of how do we think about the politics of fiscal space. But if we cannot overcome the radical institutional change that is necessary to do it on the public balance sheet, then you mobilize private capital. So the idea is you mobilize private capital by trying to, South Africa did this, by trying to think through what would it take for private investors to set up independent power producers, right? These are how independent power producers, wind farms, offshore, onshore, or solar farms. And in order to mobilize, to de-risk private energy or private renewable companies, there is typically a blend between donor de-risking and local de-risking. Donor de-risking basically can take the form of loans to the IPP, to the independent power producer, loans, de-risking guarantees, first equity tranches. If you go on the website of the OECD, it has a private capital mobilization dashboard that shows the successes, in between commas, of donor de-risking in mobilizing private finance, and you can look across sectors, including energy, right? So first, the donors will de-risk by giving some subsidies, or loans at preferential rates, which improve, risk-adjusted returns for these private investors. And then they will say, this is not enough, because even if let's say I set up my wind farm in Kenya, you reduce the cost of capital for investment with donor de-risking. I still have the problem of who will I sell my energy to, the renewable energy that I'm producing? Who will I sell it to? On what terms? Is the grid going to be able to absorb it? Is there energy infrastructure going to absorb it? I need to take all these risks into account. What about political risk? What about the risk that, progressive government will increase wages and make everything more expensive for me, et cetera, et cetera. So typically, alongside donor de-risking, there is local de-risking or government de-risking, where the state-owned utility says, I will buy your energy for the next 20 years at this price. This is the quantity, this is the price. These are privately negotiated contracts. And they turn out to be quite expensive. And I put in the chat there our project called on Red Cashew for African countries, and it's the same pattern everywhere. It's an expensive way of getting energy produced by locally by private investors, and you can map the same for almost every other sort of SDG sector that I can think of. So that's the configuration, right? Always the idea is the investors would like to increase returns and by shifting some risks to the state. How much risk is shifted to the state very much depends on what kind of negotiators you have in government, what kind of negotiators you have, what the World Bank says, what donors say, what they are willing to accept or not. For example, for the Lake Turkana wind project, which in one of the pieces in the Phenomenal World, which I did last year from Seville, we show, for example, that for Lake Turkana, the World Bank said this is too expensive for the Kenyan state, I'm not going to support it. But, European DFIs supported it. And even I heard last week in Paris at the OECD, European DFI saying, oh, this was a great project. And I asked them, yeah, it was great for you because it provided you with very nice returns, but it's so expensive for the Kenyan state that there is a parliamentary investigation and trade unions in Kenya are pushing for a renegotiation of the de-risking terms. So this is what I mean basically by it, and this is to me why it's important to push for transparency, because the World Bank promised transparency in these liabilities that are either contingent, that is they are off the balance sheet or they are on the balance sheet of the state. The World Bank promised transparency, but if you look at they have a PPI database. In that PPI database, you basically find no useful information to speak of. We had to hire a researcher who looked at the IPPs, these independent power producers in these African countries. And the data that we got is very different from the data that the World Bank presents. So even this would be a great win to say to European donors, why are you putting money in projects that are very expensive for countries in the global south, and we have no data on it. We have no data. We only find out the problems when there is a public scandal, and these public scandals are kind of popping up everywhere. I would say that's the broad framework of de-risking and the investable development. With JTEPs, the Just Energy Transition Partnerships, there are several countries who have been undertaking it, Indonesia, Vietnam, Senegal, and South Africa. And what we see there again is the problem that basically they cannot, because they are prioritizing constantly investor returns, they cannot deliver on the kind of grand promises of decarbonization that they made. There is no, even anywhere that I can look, that I've looked at, there is now growing research that says it's not possible to decarbonize with mobilizing private capital. Not at the pace that is required, not at the scale that is required, and definitely not with the developmental outcomes that are, ideally baked within this promise of mobilizing private capital.
Super, thanks a lot. That was super helpful. Jodiane, do you want to add something maybe also on the carbon finance?
Right.
She's good.
I think earlier you were also, people were mentioning, going back to the point about profitability. So I kind of wanted to just elaborate on it a bit further. I think we're still going back to the contradiction. Well, like we're being told that there's not enough public finance and we need that private finance there quickly, right? And so to understand like why is there a claim that private finance arrives more quickly than public finance, or where has it gone? Well, private finance does not also respond to vulnerability or the social need, right? As a primary objective, it's guided by other logics. It's guided by the fiduciary duties to generate returns. But also on the other hand, I think what was incredible that came out of Santa Marta, the first conference on transitioning away from fossil fuels, was the heavy focus on investor-state dispute settlements, which, it's in a way a threat to countries, to governments, deterring them from moving forward with very essential climate, environmental, and human rights regulations because of, because the previous kind of ISDS system has given power to private finance to be able to take legal action against the government for essentially losing their expected profit, right? So there are these inherent dynamics that sit silently within the system that we need to challenge. Similarly, when we think, cost of capital is high, credit risk is high, credit rating is low, there's weak revenue guarantees, there's a history of financial dependency that a lot of these countries didn't create. So why is then if these are the problems, why is the solution putting forward private financing? Why is the solution being put forward not thinking about the colonial underpinning of a lot of these debts and thinking about debt cancellation, right? Or thinking about fairer tax systems towards polluters. So even when we're getting pulled into that logic again, I think we need to take a step back and be like, there's a lot of politics that we can unpack within these terms.
Daniela, do you want to go quickly, and then I hand it to Serge for the second question?
Yeah, I just wanted to note in response to Jodiane that reading the Santa Marta, outcomes, I'm a little bit worried because there is one of the pillars, the streams on private capital mobilization, sounds to me a lot like de-risking. So even countries that are theoretically, much more committed to decarbonization and transition away from fossil fuels, they are still locked into the private capital mobilization logic. And we have to ask, why is that the case, and what can we do about it? And just to answer a couple of questions very quickly from the chat. First, I would say I would invite a colleague from South Africa who has described a success in the RAPE, the private capital mobilization in energy. I would invite them to look at our research. It's going to be, we have granular data at IPP level for the cost associated. And from the research we've done, I think we have to be very careful about the narrative of success of the South Africa de-risking energy project. And Laura Alize, I would agree with you that it's in practice, it's very difficult to design, they call them KPI. This is what I heard in Paris last week at the OECD, that they are trying to, that at least DFIs, development finance institutions, are thinking about KPIs for private capital mobilization. Even if it's very difficult to kind of work in there some kind of developmental impact or development outcomes, as the Seville Compromiso calls for, it's throwing sand in the wheels. I think, to be frank, from where we are in global politics and from last week in Paris, my sense is that however much we call for justice, for retribution, for recognition of colonial and climate debts, the world is moving into the other direction. At least global north countries are moving into the other direction. They're talking about partnerships between states now with a kind of win-win situations, by which they mean tide aid for their corporations. And the world we are heading in is not a world where we can make lots of gigantic claims towards global north countries, because they're simply not going to deliver. It's not a political reality that we can dream of.
Super, thanks a lot. Tasneem, I see your hands up. Do you want to comment quickly on this?
Yeah, sorry. I just wanted to say, Daniela, that Thuli actually wasn't saying that the REAP in South Africa was a success. It seems that they'd like to present it as a success, but in fact, there's been a number of traps in that project itself, in that program, if I can say that. And of course, being South African myself, we have learned so much about that project and the JET-P as real examples of what both you and Jody Ann have been mentioning in terms of the narrative, but also the way we get all drawn into this. It's good for the economy, it's good for people. To mention, of course, as Jody, as you have indicated, what happens in the end is that we are looking at this only from maybe, the financial risks, etc. But in the end, we have to look at this in relation to climate justice and justice for communities. The REAP project, for example, in the legal instrument around this, the government put in place things like there has to be a community trust that will be shareholders in the REAP project. They put in place, there must be a fund for small enterprises that will have to benefit from those benefits have not been tracked. And in fact, in the early stages, I actually had the privilege of going to meet those communities that were meant to benefit from the REAP project. And seriously, there are real problems with that. It's just the whole thing was designed in a way that would never get communities to benefit from that. So that's the part that's often hidden and invisible in these kind of private sector driven programs, that governments start out with good intentions, and in fact, we lose out in the end and communities don't really benefit. So I just wanted to flag Daniela. Thuli, I think, doesn't say it was a success, but also to add some dimensions of the non-financial, if I can call it that, aspects to this push for private sector investment where communities actually don't benefit, and climate justice or any form of justice is actually not materializing. Thanks.
Yeah, thanks, Tasneem. And that's also the things that were put forward by governments themselves to sort of sell these platforms and programs. One last question, and then I give it back to you, Rebecca. So the last question actually from the chat, someone was asking to Daniela specifically how to what extent she thinks that the sort of Wall Street consensus is rooted and embedded in UN institutions, UNEP, UNDP, I think he was mentioning. And also maybe if you, I mean, we have a short limited of time, but if you can also maybe tell us, based on your experience in this UN special committee to Sevilla, and also another, the second last question then is also because you insisted, Daniela, but I extend the question to Jodiane. How do we hold private finance accountable? Because as you said, one of the key outcomes of Sevilla was also to make sure that basically private sector interventions are aligned with SDGs. So whether you have basically any sort of recommendations to our auditors, and then back to you, Rebecca, to close.
Okay, thank you. Very quickly, I think my observations is that the Wall Street Consensus is deeply embedded in almost UN agency I can think of. The UN DESA, and it's embedded, it doesn't need even to be ideological. I would just like us to remind ourselves that the reason why we are saying private capital mobilization is the solution has to do with the constraints of the international financial architecture, with our inability to fight big or to get big wins on fiscal avoidance, on illicit financial flows. There are a host of political issues that are reducing fiscal space because of global structures of accumulation. And because nationally, to say the alternative to the Wall Street consensus is to bring back a strong developmental state that is able to discipline capital, where central banks are not independent of government, they are not working as outposts of private finance in the state, they are cooperating with the government and coordinating for developmental strategies. There are a whole, the kind of institutional change that is necessary to move away from the private capital mobilization agenda or gigantic or radical. And even many well-intentioned people in the United Nations cannot envisage the politics of making this institutional change possible. So because there are these structural constraints as well, then you have a lot of UN agencies saying, you know what, private capital mobilization, UNCTAD, if you look at the United Nations, family, UNCTAD, until 2 years ago, until it changed its president, was the only UN agency that constantly said, no, de-risking and private capital mobilization is not a good idea. These partnerships are baking injustices, post-colonial dependencies, blah, blah, blah. Even UNCTAD now is saying private capital mobilization. I have all sorts of theories of why this is the case, but since it's recorded, who cares? I'm not going to elaborate them. I would just say it's deeply entrenched, and my experience is, that there are margins for fighting, and this is the bigger question is, how do we fight, or what can we do about this? And insisting on aligning developmental impact is putting the burden on the shoulders of the UN agencies, on the shoulders of donor governments to say, yes, we committed, we've signed this statement in Seville last year, we committed to align development outcomes. It's our job. It's not the job of the civil society organizations to come up with KPIs, with key performance indicators that monitor development outcomes. It's not the job of civil society. It's the job of those who are promoting de-risking and private capital mobilization to demonstrate that there are no adverse developmental outcomes. It's a very hard job because this is how the model works. It generates adverse developmental outcomes. But at least to demand some level of accountability is, to me, a very gigantic first step. To say asset level data. When I talk about asset level data, I mean every IPP in South Africa should tell me how much it generates in fiscal commitments for ESCOM. Every private hospital in India that is de-risked by concessional aid should tell me how much money is the British investment BII, I can't remember what it stands for, how much money has given to US private equity to de-risk health inequalities in India. If we insist at least asset level transparency, it's a gigantic step forward, because then people will understand that when we're talking about private capital mobilization, we're talking about privatization. We are privatizing every social and public good I can think of. So, and this is something that, and I'm going to stop here, this is something that has been resisted for a very long time, even if the World Bank promised to do it otherwise, because the moment you are transparent at asset level, then the subsidies to private investors become very obvious very quickly.
Thanks a lot. That was very clear. Maybe Jodiane, do you want to close very quickly, and then Rebecca? Sorry
Yeah.
to be.
I think the one thing I would ask is that I think as civil society movement building, we need to better equip ourselves and stop mystifying private finance. I think we try to do a lot with demystifying private finance, and also it's not just particular instruments or dynamics, but it's other things that assist its entry, right? So thinking about like taxonomies and ESG principles and disclosure frameworks and all these other things, and what the heck are we talking about when it comes to that? And I think there's a lot more effort and work that needs to be done to unpack also the power and politics of these tools as well, because they're still not changing the fundamental underlying order, but creating a lot of facade and performance around kind of the entering of this moral environmental values into the fundamental financial logics of seeking expected returns.
Thanks. Thanks so much, Daniela, Jodiane, Tasneem, Hamdi, Saer, for this great first session. I think we could not have dreamed of a better introduction to the finance goal. So I'm really thankful. I'm also really mindful that we are at time, but that's how it goes with good conversation. I'm also really thankful for participants to still be on. I see a lot of you still on the call, so I hope it's showing your interest to the discussion. So I just wanted to share a link with you all. That's the toolkit that would accompany all the different sessions of the school this week. We're going to have the recordings, the materials. We're going to also do kind of a summary of the speaker's intervention as well as key takeaways, so that hopefully this is accessible and digestible for you, because it was a lot. That's the goal, right? To collectively go on a school education journey, but it takes time to digest. So that's why we're proposing this support. So I'll paste it now in the chat, but also we will share it through emails to all the participants. So I will now wrap up. Thank the speakers again, and see you hopefully tomorrow for the second session of the Finance School. Have a very good day, evening, afternoon. Bye-bye.
Bye-bye.